Hello, guys. Welcome. So, I have a kind of bad news, and it's not a bad news though. So, I want to welcome everybody to this session. We had tried to initially produce this live session, but unfortunately, we couldn't. We actually did, and then we had audio issues, but we are here now and we're doing it. So today we've been made welcome. My name is Paul Confidence. I'm a managing partner at Ventura Capital. And Ventura Capital, what we do is we help you create wealth through assets. So long-term asset investment for wealth creation. That's our primary focus. And for now, we have land instruments that are going to drive a lot of wealth creation in the next 5 to 20 years. We started a series called Investing 101 after we finished our 10-part clarity series on land ownership and land investment. We just started this one, Investing 101, and we started the first one where we did investment, understanding investment and the mindset of an investor. And we had a very insightful and in-depth conversation around the topic. It was fascinating. We've been getting emails and testimonies around people who have started implementing the mindset shift that we sold to them in investment. So we said money is not the start of investment. You need to start investing in you. And then we move further to start discussing a bit about the economics. And we said that in economics, you need to understand inflation and how inflation affects your wealth. And we expanded so much in it. And now we're going into the risks and the return literacy. So under the risks and return literacy, we have what we call investing versus gambling. So before this conversation, we see a lot of people mistake investment or gamble for investment. And what we're trying to do in this particular session is to demystify and help you understand the risks and return literacy. Now, a quick understanding is we're going to be going into the 3 rules of investment and investing and what you need to understand. So, but let me start with this. How many people remember MMM and the likes of Chinmark, CBEX, a lot of fascinating MBA Forex. So we had these investments that happened, and what happened is that most people lost money. And even if you didn't lose money, you knew somebody who lost money. That lost money. That was the reality of how much their investment went bad, or the circle was large. Now, most people don't lose money because they are greedy, right? They lose money because they are not taught how to understand risks. Now, risks is a huge part of investing that a lot of people like to shy away from. What you see with the investment experts or content creators who are doing a lot of things around stock. Now, remember, we've appreciated them so much. I've said that they are doing a lot of amazing work, but you need to understand risks, right? So one of the things that happened recently is the market, the Nigeria stock market closed recently. That's last week. It closed, and it was crazy that there was a huge loss that amounted to almost 3 trillion naira in the Nigeria Stock Exchange last week. Now, one of the things we had said is this: your interesting not influencers, content investors, creators, right, would not tell you these things, but we saw that other markets went down, and while they are hyping the conversation of buy stock, it's a very fascinating one, but you need to understand risks, and that's what we want to talk about today. Many Nigerians like to calculate profit and they never calculate risks. So a lot of people just want to say, how much am I going to get if I'm investing in this risks? And just tell me how much money am I potentially able to get from this investment. Now, the thing is, in investing, risks really matters. You need to understand that risks matters. And we're going to be expanding it into 9 sections. First one is why most people focus on returns instead of risks. So like usually, or like I always do, I have my writing notes, I have my tabs, so you're going to allow me just reference a couple of things that I've jotted down across this learning tools that I'm going to teach you. So this is not your regular motivational, vibe driven webinar. No, this is a very detailed, researched and organized webinar like we have been doing in all of our series. So first, you need to understand that most people who hear investment, the first thing that comes to mind, or the first question they ask is, how much will I get? How much will I get? Now, professional investors usually will not ask this question. Their concerns will be a lot around how much can I lose, right? What is the risk factor that is available in this your proposed investment that you are giving to me? Now, that's a completely different mindset. Remember, we've talked a lot around mindset. You need to understand that it is a basis for investment. Investment for us, the investment journey is not a short-term thing. It's a long-term journey. And in a long-term journey, you need to factor in a lot of things. So you are not just swayed by the get-rich-quick scheme. So we live in a society where everybody is now chasing the bag. I mean, good. But people want to get money, make money so quick that they fall into the traps of gambling, scam, and Ponzi's. So how do you prevent this? That's what we're discussing. So we've said that you need to ask the right question. As against asking how much do I make, you need to focus on how much can I lose. So we have a scenario we're going to paint now, and it's the first part of, and a Nigerian has a million naira, right? And the million naira, he gets the option first of saying 15% yearly. That means potentially he's going to be earning 150,000 at the end of the year. Then there is the option 2 that says 50% monthly, right? I mean, some of you can totally relate to this. And the expected return is 500,000 every month. So most people will go for option B. And why is that? Because the human brain is wired to be attracted to reward. I mean, most times, what are our motivations to do things is the reward that has been sold to us. But very few persons are going to ask questions like, how is the money generated? How is the return sustainable? I mean, you can't tell me you're going to be giving me 50%. What are you doing with the money? I mean, did you plug it? Did you plant it somewhere and then you're expecting it to, even if you plant it, I mean, how often is this, how sustainable is this thing you have planted? I mean, you need to understand these questions. What is the downside? Who regulates the company? We don't ask these questions. We're just concerned about, oh wow, hey, 50% I'm going to be getting from this investment. So an average person chases returns, but an investor studies risks. Remember, we're talking risks and return literacy. And then we are understanding investment versus gambling. So a lot of people focus on returns, but investors, remember, we're trying to get you to understand the investor's mindset, because once you understand the investor's mindset, only then can you now position yourself to create and build wealth long term. Remember, wealth for us is long term. We'll expand on that as we go further. Now, understanding risks in simple terms. What is risk? Risk is the possibility that reality will be different from your expectation. What that means is, I expect to get something and then something happens. The example I like to give is, I and a friend invested in a logistic business in 2020, and it was a fantastic business. Okay, I mean, let me even talk about this one that is more relatable. So we invested in a factory late 2020, and we were producing donuts, fascinating 3,000 donuts. And one of the challenges we didn't envisage was COVID. Borders closed down. Now, we didn't factor in that risk, but we had expectations, right? So risk is not volatility. Volatility has to do with ups and downs of like, oh, inconsistency. Risk is not uncertainty. Risk is the possibility of losing money permanently. That is, you need to understand that in risks, you can completely lose your money. You can completely come back with zero amount. I mean, I've said this before, and I say it every time I talk to investors and our circle. I tell clients and people that are looking to invest, ask the right questions around stock markets. There is so much conversation about investing in the Nigerian stock market, and I mean blue chip stocks. But you need to ask the right questions. You need to understand the risk factors around these things. So I have the analogy I want to share with you. Think about this. A Nigerian is traveling, or you are traveling from Port Harcourt to Lagos. And there are three options. The first one is commercial flights. Now, that one has fast, safe, and predictable. Then you have night bus. So I'm going to share a story about night bus after I share this analogy. So the night bus is cheaper, is more uncertain, and the risk is higher. Then you have the third option, which is jumping on the back of a random truck who promises to get there in half the time. Now, he does not tell you how he wants to go or how fast his vehicle can go. He just tells you, come on, get in this vehicle. Now the thing is highest potential speed, right? It tells you, oh, you're not going to spend for the cost, you're not going to spend, Lagos by flight is like 45 minutes to 50 minutes. You're not going to spend 45 minutes. I can take you there in 30 minutes. I can get you there in 30 minutes, and I can take you even cheaper. Once you ask questions, now the chances of disaster in that one is high. So the example that comes to mind for the night bus is a story. I had a friend, I'll call him a mentor. He had a major project in 2019, and we had to go to Lagos. Now it was for the rebranding of a major sports betting company. Just give me a minute, guys. Okay, I'm back. Sorry for that break. So we're going to make that trip, and we got the email late for the invitation to come and present, and we had to jump on a night bus. We didn't have the resources at the time to get a flight, and it was short notice. Not like the resources was not exactly the problem, it was the notice that was really short and the timing. So he said we should get in the night bus, and then we started going. When we got to between Delta States and Benin, we had a fascinating experience, or an interesting experience. So our driver was going. We didn't enter the big vehicles like the Marco Polos and the BRT. No, not BRT now. It's Lagos vehicles they call BRT. So we didn't enter the Marco Polos and the coasters. We entered a 18-seater bus, and while we're there, we're going smooth and steady, and then we saw a vehicle similar to ours, black, drove past us, got in front, and stopped. It was fascinating. It was very funny. So our driver had to slow down, turn off his lights, and we noticed that our 8 men on black came down from that vehicle, got into the bush, and people were scared. I mean, for me, I usually don't panic in situations like that. I always have it together. So the after they had come down, got into the bush, the other driver turned the vehicle and passed us. We waited for a while and then we went. And it was just a very funny incident that I always like to remember. So the principle we're basically trying to talk about is making money is important, right? But keeping money is more important. You need to understand. Making money is good, but keeping the money is even much more important, because if there's no money, you need money to make money. And the difference between investing, trading, and gambling, you need to understand that most people suffer, confuse because of these three things. They don't understand the difference between these three things. And to understand it better, let me explain to you. So first, what is investing? Investing is you put your money in a productive asset and it creates value over time. Hold on to the keyword over time. Over time means that it's not like you're going to get back the money tomorrow, right? I mean, it's a compounding effect. We've talked about compound interest in the previous webinar we're doing in inflation, right? And you need to understand that some of the assets you can put your resources in investments include real estate, business, stock, bonds, and agriculture. Now, what are the characteristics of these assets? First, they are cash flow, right? They are economic activities. They are productivity driven, right? And then they are long-term value creation. I hope you're following me. They are long-term value creation. Now, buying land in a growing area, because population growth and infrastructural explosion with demand will come, that is investment, as against some of the other things. So let's understand what trading is. Now, trading is buying and selling stocks, or assets rather, buying and selling assets based on short-term price movements. For example, you have forex trading, you have crypto trading, and then you have stock trading. So one of the movies I always recommend when it comes to trading is the movie Industry. Industry is a 5-series UK movie on young interns who got into investment and grew up the ladder. Now, it really teaches a lot about trading. And one thing you need to understand is trading is not gambling, and here's why. Why is trading not gambling? First, trading is strategic. Trading is risk. They have risk management. It's discipline driven, and it's position sizing. So one of the things I saw in the movie industry got me to understand how that different factors could affect or improve trading, right? So one of the things that happen in industry is how that once they predict a market's move, and then based on data and strategy, the brokers call the stock owners and tell them they want to put them in a trade, or the owners of the stock hears a classified information. Sometimes they just talk about inside trading and how you get insider information and all of that. I mean, those are another conversation. We can have that webinar on its own, right? And the owners of the stock call the brokers, the brokerage firm, and tell them, oh, I want you to put me in this trade, because it does not even, most times they don't even tell you, because they just tell you, put me in this trade. Then sometimes too, the traders need to advise wherever they are holding the money. So what you need to understand that that is trading, strategic, position sizing, risk management, and discipline. Now, one of the things we've seen in Nigeria is how that a lot of people have lots of Telegram groups where they say they are sharing random signals. People use borrowed money to expect and hope that they get profit. That's not trading, that's gambling. I mean, there's one I saw recently that's been trending, AI Forex trader. And then it tells you how, oh, this AI Forex trader has just made $100,000. Please hold your peace. So you need to understand difference between trading, investing, and gambling. Now, what's gambling? Gambling is risking your money where the outcome is speculative and there is no actual value to be created. So, for example, is sport betting, casino games, and lottery. I mean, the danger here starts with the fact that a lot of people have positioned gambling in disguise as investment. Now, we've seen that with NBA. I mean, how are you promising somebody 30% monthly, 40% monthly? It is disguised as investment in the name of it's a disguise of gambling as investment, right? Understand this now. Why do Nigerians keep falling to this scam? The first one is inflation. Remember, we talked so much about inflation yesterday, and we explained how inflation is a factor to this, and we said how inflation has affected pricing of items, right? And then one of the other things is currency depreciation, right? Rising cost of living. This is the reasons why Nigerians get involved in scams like this. People feel pressure. People want financial relief. That makes people vulnerable. So somebody said something that Nigeria is one of the easiest places you can make money. Nigeria is one of the easiest places that you can make money out of people because they are very vulnerable, they are very gullible. Now, what is the scam formula? The first one is they tell you an unbelievable return. Understand? There are 5 steps in the scam journey, how they scam people. So first, they tell you what we call the unbelievable returns. Now, they don't explain any risks, right? They just tell you, oh, come and invest in this AI bots, AI trading bots, or this investment. There were even times they did agricultural scheme that were fraudulent and were just scam. So they tell you, oh, you get 30% returns. And then the next thing they do is they create social proof. Now, by social proof, they now start sharing screenshots of people who are investing. They now use lifestyle, right? They use cars, they use withdrawal screenshots. The next one is urgency. Do not tell you, it's only for a limited time. If you don't come now, the window is closed. Then the other one is they use trust. So they now get involved with religious organizations. I mean, I feel like those religious organizations need to be dragged and dealt with, even sued to court. So they get religious organizations involved. They get family members to now evangelize people. They have influencers. Now, one of the things we've seen recently is how that people still fall for this trap, even after the likes of MMM, MBA Forex, and other investment schemes, gamble schemes that has come up in the name of investment. People still fall prey to these scams, and this is because of the trust factor. We like man no man kind of arrangement, right? The last part of it is when your money disappears. So after all these things they've done, after they've done this, they now run away with your money. So usually scams sell hope. They tell you that this is the life, this is the dream, this is what you can achieve. Scams don't sell investments. They sell hope. Make money, buy a house, travel abroad, buy your dream car. Those are hope driven activity, very short-term based. Now the risk and reward relationship. So risk and reward have a relationship. They like to say they are married. Fundamental rule is that higher return requires higher risk, and there's always no exception. So what that means is the example I gave in the other webinar where the master, from the Bible, the master had servants, gave them talents and traveled. Now to the one who had multiplied his talent, he took every other person's own and gave to him. So because the master wanted higher returns, because the person had doubled what he had, he took higher risks. So what am I saying? Now there are different kinds of risks I want to explain. Now the first one is the low risk. An example is treasury bill. Treasury bill presents a very low risk, and One of the things we're going to do in one of our sections is to explain treasury bills, mutual funds, bonds, so you understand how it works. And the next one is real estate. So real estate risk is usually moderate. I'm trying to pull up something. Real estate risk is usually moderate. There's a slide that is I'm going to run us through after I finish the explanation. As we always do, we always have the slides that are available so that it can guide you to see a visual representation of the things we are saying. It doesn't just sound like it's all talk and gist. So real estate is always moderate returns and moderate risks. The next one is stock. Stock has higher potential for returns, but there's also higher risks. So I just explained when I started the webinar how that Nigeria Stock Exchange, the market closed last week, and one of the challenges, one of the things that happened was there was a huge loss, the highest we've seen this year. And I told you that most of your influencers and stock content creators do not mention this part to you. They just sell you the fact that, oh, do this, put your money in the stock. And I'm not against stock market trading. I mean, I am also a stock. We invest in stock. But while our focus right now is not on stock, it's on real estate. But you need to understand the nitty-gritty of what you're trying to put your money into. So another one that has very high risks and also extremely high risks and higher returns is startup investment. So we've seen Vizu Mokwayo, he mentioned how that business, at least every day, on the venture capitalists and angel investors are investing at least 4 businesses every day, and that number keeps going higher and higher. We've seen how much venture funds has come into Africa in the last 5 years. Especially Nigeria has experienced the largest of it, and then we've seen several startups fail even after receiving these funds. What does that speak to? It tells you that the risk is extremely high, but the return is also extremely high. One of the examples I like to give about the returns being high is about the guy in MoneyPoint who worked with them for about 10 years, and when MoneyPoint became a unicorn last year, as their valuation got to $1 billion, he cashed out and retired. He trended on X, that's Twitter, and LinkedIn for a while because he didn't tell us what his stock dividends, but people started speculating what his stock returns were going to be. And the interesting thing is, nobody speaks about how much extremely high the risk is for startup investment. Remember, we're talking about risks and returns. You need to understand this, that they are married, and you cannot separate either of them. When someone promises you high returns, guaranteed returns, no risks, that person is just selling a scam to you. He is selling a scam. Every investment vehicle has a risk factor. It depends on how much risk are you willing to embrace as an investor. That's why I have explained these 4 different categories of risks. Now, there are other investment vehicles, but I just give you these 4, from treasury bills to startup to real estate and stock markets. You need to understand. So, what's the myth about returns? What's the myth about returns? Now, if someone can genuinely generate 30% monthly, like they used to sell to you, some of you guys are swayed by that. If they can confidently generate 30% monthly, why do they need 100,000? So, one thing you need to understand is true wealth, true rich people do not really tell you what exactly. Of course, you can investigate and say, oh, this is where this person makes money from, but they don't tell you exactly how that money is made. So if somebody comes and is promising you, oh, you buy a car, come and buy this, I don't have a problem with courses, right? I don't have a problem, but you don't need to sell it to people as a hope to, as an escape from funding to. So why are you selling it to me? Say you are empowering me. That's what those AI traders and all those forex guys will always do. They tell you they're empowering you. Push it with your bank. Take it to the bank. The bank needs money. The bank is constantly looking for people to take loans so that they can make money, because they make so much money from loans as against when the money you put into the bank as your savings. The bank takes that money and gives to people that have good credits to trade, do business, and bring returns back for them. So you need to understand something. If these guys that are claiming that they can make this much in a short period of time, why are they not going to the banks? Why are they not going to institutional funders? You need to understand that thing. So, critical thinking framework, when somebody says it is guaranteed, guaranteed by who? What is the asset? What is the conditions that guarantee that this thing? What is the legal structure? People don't ask these questions. They just, once they hear the word guaranteed, don't worry, madam, if you buy this land, by the next 6 months, it's guaranteed to go up by 30%. Who told you? How? What is the data? Sorry, I'm sounding very... I feel like a politician. So there's one of our Nigerians interesting politician that sounds like that. So you need to know that the word guarantee should make you investigate harder, not invest faster. When someone comes to sell you a land deal, like I see with a lot of realtors get to experience this, do this a lot, where they sell so much hope and guarantee. Smart investors. And then they tell you how that you're going to get guaranteed return. What if? So you need to understand now, due diligence is the skill that saves investors. Due diligence saves investors. And what does due diligence mean? It means verifying before trusting. So one of the things we talked about in our 10-part series in Ventura is how that people buy out of trust without getting to do their verification and groundwork. Smart investors or investors always ask questions like, how does this business actually make money? I have a story of how I had a senior colleague who did a scam of almost 8 billion naira. And one of the things that happened was that I had a friend whose dad was about to invest about 50 million in that scheme. And then I kept asking him, how are you actually making this money to give people their returns? And there was nothing coming. And I told her, please don't invest. Even if they took the money and went to MBA Forex and lost it, I felt safer. And the fact that I saved them, I saved my head, because they would have said, oh, Paul introduced us to this investment. So some of the questions you need to ask is, who is regulating these people? Who are they registered under? Do they have the licenses they need? Can the business survive economy? What are the risks? A genuine investment opportunity discusses risks openly. These ones will not tell you what are the risks available. They just tell you, don't worry, our bots never fail. So something happened recently, right? I was invited to a private exclusive investment pitch by an investor, fascinating man. He had done incredible things. He has good reputation. And when he started talking about it, and someone asked, so one of the people on the call, were about 6, started throwing in a lot of risk questions about the fact that, they've seen things like this and how these things fail. And what is... So he got angry and said, my reputation is on the line. While he was talking, I said, let me Google it. I Googled the name of the company. Interestingly, SEC, Nigeria Security Exchange Security Exchange Commission in Nigeria, had stated in an article that this particular scheme is fraudulent. They don't have any license to operate in Nigeria, and there's no regulations that guide them. You need to understand. So, I just said that thing and I kept quiet. I didn't have to bring it up in the call. But the point is, you need to understand that you do your findings. Don't just jump at anything that they tell you guaranteed. It doesn't matter, even if it's your pastor. These guys know how to use religious leaders a lot, and people are affluent. So I remember when my dad fell for a scam like that, and they used his senior bosses in the office to sell it to them. So what happens if things go wrong? These questions will eliminate many scams. So you need to ask them these questions. Now, what are the 3 rules of the investment? We've talked about the questions and understanding scams, right? What are the 3 rules of investment? The first one is do not lose money. Now, the fascinating thing about this rule is Warren Buffett's rule. Warren Buffett, 2 rules of investment is rule number 1, do not lose money. Rule number 2, make sure, go back to rule number 1. So, do not lose money. Capital preservation is what makes money grow. Before making money, protect your money. Do you understand? Now, rule number 2 is never invest in what you don't understand. Now, I tell people this a lot, that I have never fallen into this scam of a get rich quick scheme or any of these Ponzi's that usually rise in Nigeria. And this is because I don't like to get involved with what I don't understand. For me, I'm big on knowledge. For me, I'm big on understanding. So when I had friends doing MMM and making so much money from MMM, one of the things I remember I always did was told myself, oh, I was not ready for this because I don't understand. How are these guys making money? I mean, they are circling money. This person pays this person and the circle keeps going. What happens? So you need to understand, wealth is not sophisticated. All those people that come and start giving you big grammar, we have a technology that is still this. Okay, explain to me like a 10 years old. Complexity is not intelligence. If you cannot explain it, if they cannot explain it to you in a simple way, don't fund it. It goes to every aspect of investment. If someone has not, they can just come and tell you, oh, put your money in treasury bill. I've said it's low risk, right? But understand it. That's what an investor does. Remember, we spoke about knowledge in our first Investing 101, part 1. We talked about how that knowledge is a huge factor. The knowledge that you need to go from 100 million to 500 million, knowledge you need to go from 1 million to 10 million, they are different. So that is what makes you an investor that is focused on wealth creation. Don't get into the game focused on vibes and quick rich scams. Now, returns is secondary. That's the 3rd rule. Returns is secondary to survival. The goal is not to get rich quick. The goal is to play. The goal is to stay in the game long enough so that you can be wealthy, because that's what we're doing. We are practically here to help you get wealthy. We are not here to do some get rich quick scheme, which some real estate companies sell, which some investment vehicles sell. They tell you do this. We've seen it a lot of times. For us, we like to talk about the fact that before you even invest with us, you need to think of a 5 years plan. 5 years plan on how you can put your resources with us, and that resources can grow based on data that we have gathered, based on infrastructural roadmap. Capital preservation, the forgotten wealth skill. Now, most people think wealth creation is about multiplication. Wealth creation is about preservation, right? Imagine carrying a bucket of water and that water is leaking, and you're going from here to maybe 1 kilometers. That's even far. Let's say 100 meters. Before you get there, that water must have lost most of the value of water, and the quantity of water in the bucket must have reduced so much. So investors focus on, generally, some investors, most investors actually focus on returns, profit, and opportunities. Why few investors, the ones who stay in the market and stay in the game long enough, that are creating wealth, focus on risks, protection, and leaks. So why returns and opportunities and profits are good, you don't need to just jump on everything. You need to ask yourself the right questions. Now, wealth, a fortune preserved grows. A fortune destroyed starts from zero. You need to understand that you are preserving wealth. The goal is to create wealth over a period of time. The goal is not to fall trap based on gullibility to the trap of get rich quick schemes that are everywhere. We've seen what has happened with influencers. We've seen what has happened with religious leaders. We've seen what has happened with closed circle. Now, even with all of these things happening, people are still falling, because now these guys are not even going online again. They're now focused on small groups. They go to the market, go to the women leader in the market and tell her to tell the other women that there's this investment. People start putting 100,000, 500,000. For long, this scheme disappears and people lose their money. We also see the same thing in real estate. So imagine two investors. The first one is looking for the next big opportunity, and the other one is patiently building wealth. You need to ask yourself, where do I fall into in this, in the grand scheme of this? When you understand this, it will help you and protect you to build sustainable wealth. Wealth is built by avoiding extraordinary loss. Because you're chasing the next big thing, you're going to lose money. You lose money. But wealth-driven investors focus on long-term compound interest. Your first responsibility as an investor is not making money. It is avoiding unnecessary loss. Because you can make so much money, and one wrong move can have you lose all that money. The people who become wealthy are not always the smartest. They are usually the ones who stay in the game long enough for compound growth to do its work. Understand this. So I'm going to go straight to sharing my slide. It's a very in-depth slide on the opportunities that are available and explaining all that I have said. So the first thing you need to get is the risks. The truth about risks. What's the truth about risks? And we have said that why most people lose money, how risk affects work, and the practical blueprints to wealth preservation or wealth protection. Slide 2. Now, the retail loss epidemic. Now, understanding that the multi-million billion dollar, multi-billion naira pattern of high yield investment scheme failures in the Nigerian system. Now, there is that scheme that has happened. People have lost billions of naira in those schemes. You need to understand that the hard reality of these high returns is usually we've seen the likes of Chimac, MMM, MBA Forex. Now, almost every Nigerian has either lost capital, knows a victim, or came directly close to investing. I explained to you how, okay, I didn't explain, but I was going to mention that. I remember how I was trying to get my mom to invest in one of these schemes. The core issue is most people do not fail because of greed. They fail because they focus entirely on returns matrix while ignoring the risk factors. Now, while many can calculate profit, only a few can structurally, financially understand risks. The next thing is the great illusion, the great investment illusion. And what does that? Oh, my next slide. So the great illusion is option A, capital preservation. So initial investments, we've talked about this already, but I'm just running through it again. We have 1 million naira, 15% annual returns, which is 150,000, and it is for a period. So this is more boring, but it's stable and sustainable, as against the speculative trap of 1 million, 50% monthly returns like we see with these schemes, right? It is, however, almost no legal, or most of these people, they don't even do legal, so they don't even ask these questions. So when you look at the clause, you take them to court, they show you very vague clauses that they've put that you did not see because you were just focused on returns. Next one is what risk actually means. And we gave the analogy of Lagos to Abuja by night bus, by plane, and then by a guy who says he can get you there half the time, with spending half the time. Now, the risk is not the market volatility or price devaluation. The risk is usually the structural possibility that reality deviates so far from expectations that your capital vanishes permanently. So what are the other things that we talked about is the spectrum of capital activities. Investing, now where you can put your money, that's capital activities. Investing, trading, and gambling. And we've established already that investing is basically saying allocating capital into productive assets, while trading is short-term price movements, speculating short-term price movements on assets like currencies and commodities. So people do it for gold, for silver, and several other items. And the last one is gambling, deploying funds to speculative activities. So we now have this anatomy of scam. So this is the 4 way they get to scam you. The first one is the bait. They give you a huge potential return, right? Out of greed and relief hook. So they tell you become a millionaire in 30 days, 60 days, make double your profits, those stocks. Now, the next thing they do is social proof. They now get early investors to show luxury, cars, houses. Then you now have FOMO. You have FOMO, fear of missing out. I've never ever had FOMO. I always tell myself that I can do things the right way, slowly, and achieve the result I want to achieve, as against jumping on anything that seems like the next big thing. So the next one is urgency. They make it fast. Oh, pressure. Do it now. Panic. And then the last one is they use their vanity net. And that is your religious leader, influencers. I think one of the ones I've seen most recently is the Egungun guy promoting a lot of, even the around of Lagos. I don't intend to drag these people, but I'm just pointing out these things that they do to help to drive you to invest money. So this is the risk matrix. And I've said that we have a treasury bill, which is 15% risk index. Real estate is 45% risk index. And then we have the venture and startup, which is about 75. And then we have Ponzi schemes that are 100% risk driven. So you need to understand this investment and how the risks that are involved, because your online content creators doing all of these investment conversations would not mention this to you. So expected returns, now that's the formula. The next point is the greed, guaranteed return myth. So if someone can genuinely generate, I've explained this already, 30% monthly, why are they asking you to give them your small 100,000 or your 500,000, your 1 million? Why don't they double the one they have, or get institutions like the bank to put in the money? So how do you do diligence? Now, diligence is how does this business make money? Who is regulating them? Can the underlying assets survive economic shock? What happens if things go wrong? Now, I want to bring your attention to something. One of the things we've seen recently with the stock market is how that there's been a lot of conversations around it. And if we check the precedents, I think I established that already in the previous video, where we talked about how that the economy is where it is because of certain things that are happening, and you should not be swayed. You should do your proper research before putting any resources anywhere that are presented to you by content creators. Now, these things are narratives that are being driven unconsciously. A few years ago, investing in Nigeria Stock Exchange, I mentioned this in the inflation video, it used to be like rocket science. But right now, there are platforms that are emerging. A lot of platforms are emerging and are presenting these things to you to be easy. While that is an opportunity, you need to also do your research and ask the right questions. What is the triggers for this? Next year, we're going to experience a lot of taxing. So how would this affect those investments that we've put into different portfolios across the stock exchange? What will happen to Nigeria Stock Exchange? Remember how America fell into the big depression, the Great Depression in 1930s and 1928 to 1930, when America fell into the Great Depression, and how that affected the economy. Let's not get all hyped up and then get into that kind of phase. Why I'm not saying that can happen, I'm saying that you need to understand what you're investing in. You need to ask the right question, do your due diligence check. Now the next point is 3 pillars of wealth survivors. First, protect your capital. Be logical, right? Ask the right, never invest in what you don't understand. Compound over speed. If an investment opportunity is presented to you that gives you a more strategic and structured aimings over a period. Jump on that as against the hypes short-term investment that you could likely lose your money into. The core of what we are focused on is wealth creation, and wealth creation is long-term based. It is not about now, it is long-term based, 5 years, 10 years, 20 years. So what's the foundation of success? Foundation of success is the first responsibility of an investor is not to make money, it is avoiding unnecessary catastrophic losses, because in investing, survival is the absolute foundation of success. Once you understand this, trust me, you will prevent, you will help, you will save yourself the drama or the plight of falling into the investment trap of Ponzi's. One of the things that we have established is with our 10-part series on land investment and land real estate opportunities, we have explained in detail how you can save yourself from the trap of these things. Then, with this new series on Investing 101, we are guiding you, taking you by the hand through the process of how you can build sustainable wealth that are now based on hype and speculations or FOMO. Now, we also established that you need to define success for yourself. I will continue to say this in all of these our webinars. Define what success means to you, so that you're not swayed, you're not moved, you're not misdirected on your path. Once you understand what your definition of success is for you, from short, medium, and long term, it helps you, give you a direction, and prevents you from falling into a trap of any get-rich-quick scheme. Thank you guys so much for joining us today. Everybody who has joined, I can see your messages, I can see your live chats. Thank you. We look forward to seeing you tomorrow as we go into the part 4 of this investment series, Investing 101. And we have a very fascinating set of topics we're going to be discussing. We have the illusion of money, where we'll be talking about the stock exchange and the money trap. Then we also have the blue chip series that we're going to do stock, but most of our conversation goes back to real estate investment. Like we said, we have real estate vehicles that are presently developed by Ventura and presently in our portfolio through our investment dossier that you can tap into to build wealth one property at a time. Thank you guys so much for joining us today, and remain my humble self or confidence. I am super excited because I will be seeing you tomorrow again, and we will go even deeper